Welcome to another session of Arrow Insights webinar. Thank you for taking the time to join us today at our Arrow Private Wealth Portfolio Review and Outlook for Q2 in 2026. For those of you who don't know, my name is Peter Leggett. I'm the Chairman and Chief Investment Officer here at Arrow Private Wealth, and I'm going to be moderating today's session. Well, like most of you know, we've had a very strong level of engagement across this webinar. Actually, you don't know that, I'm telling you that, which tells us that in this complex environment, this ever-moving environment that we find ourselves in, the global world that seems to be changing every day, investors are looking for, can I just suggest three words here? They're looking for clarity, they're looking for the right perspective, and above all, they're looking for discipline in regard to their investment portfolios. And today's session, that's exactly what we want to give you, exactly that. We're going to walk through what's happened in markets beyond the major media headlines, how portfolios have performed and some of the reasons why, what we're seeing in the global and the Australian economy, and my goodness, there's plenty of changes that are going on there as well. How we at Arrow Private Wealth are positioning our portfolios today, and also where we see some of the most compelling opportunities ahead. Now, importantly, and we would say this to all of those that are listening, this webinar is not about reacting to noise, and we would encourage you that as well. There's lots of media and lots of noise, but today it's about understanding what matters and really how we position that through it. Well, it gives me great pleasure again to introduce Ryan Synnot, who is our Head of Investment Management here at Arrow. As many of you know and have met Ryan through the period of time, Ryan's been with us a long number of years. Ryan leads our investment committee, the portfolio construction, and really the ongoing positioning of our clients' portfolio. And importantly, Ryan brings a very disciplined and thoughtful approach to navigating markets like the one that we find ourselves in today. Ryan's going to take us through the presentation, so I'll step in at different times at key points and maybe draw out some additional insights and context. As always, if you've got any questions as we go, please submit those via the Q&A button at the top of the screen, and we'll aim to address those, a number of those at the end, subject to time. And if we don't get to them, please be assured we'll follow those up directly with you. Now, like all of these things, as we begin with just a brief but important note around a disclaimer. Today's presentation is general in nature and does not take into any account your personal circumstances. And as always, we encourage you to speak with your advisor before making any financial decisions. So let me very quickly set up the agenda for you. So today's discussion, going to move through 5 key areas: what's happening in the market, portfolio performance, the economic and market outlook, our portfolio positioning and our conviction and high convictions. And really, and that leads us to the last point, Ryan's going to share a couple of high conviction investment ideas. So let's get into it, Ryan. Enough talking from me. Welcome to you, my friend. Let's start setting the scene. Ryan, there's been a lot going on, particularly through the recent month of March. And I think it'd be helpful for everyone if you could step us through what's been driving markets over this last quarter. Over to you, Ryan.
Thanks, Peter, for the great introduction today. One of your best. I think just to set the scene for portfolios across Q1 2026, obviously if we wind back, 2025 was a strong year for investment portfolios, and that's probably follows on off the back of 23 and 24. What we did find over the first quarter of 2026 is that portfolios actually generated a negative return. And that was driven sort of across the board. A number of major asset classes drew down. Performance across January and February was actually positive, but that was offset by sharp drawdowns in March, largely driven by escalating conflicts in the Middle East. If you dive down at an asset class level, you will find that there are a couple of pockets of the market where positive returns were generated. However, most asset classes were in the red. Infrastructure is probably the one that stands out, generated a return of plus 5.2%, across the period and was the best performing asset class over the quarter. And I think that sort of reflects some of the defensive characteristics of the asset class itself. Cash generated positive returns, and that really rounded out the only two asset classes that generated positive returns over the quarter. Bonds underperformed cash over the quarter. Private equity generated slightly negative returns. We're still waiting on March performance to come through for a number of strategies, but private equity did continue to support portfolio outcomes, sort of limiting the level of volatility and drawdowns. Australian equities got off to a strong start. We're positive over sort of January and February, deeply in March. The US dollar as well also depreciated quite substantially across the holding across the quarter, but did provide some defensive qualities across the month of March. International equities performed poorly. This was really sort of a bit of a double whammy here for Australian-based investors. You had obviously equity markets and stocks selling down, but for investors who are holding foreign denominated assets or assets in USD, you lost out on the currency front as well. And our currency hedging program did sort of offset a little bit of the latter in that perspective. Australian listed property also sold down quite substantially. This is not an asset class that we currently have an explicit allocation to within our portfolios, but we do include it on this slide here. This was sort of induced a little bit earlier on than the conflict within the Middle East, with sort of software-related sell-offs impacting this market. Goodman Group is quite a substantial constituent of the Australian listed property market, and that's sort of involved with AI infrastructure and data center rollout, and the sell-off of that stock impacted the broader sector.
Ron, do you want to take us into some of the best performing and equally ones that didn't do so well during the last quarter, just to run us through some of those?
Thanks, Peter. So I guess within our growth portfolios, really tale of two sides here, and these numbers probably look a bit bigger than what we'd usually find in our sort of quarterly reporting or our quarterly webinars. So as referenced, infrastructure was an asset class that performed really well. It was the top performing position within our portfolio. Our infrastructure holding was also currency hedged, so it wasn't subject to some of those negative returns induced across currency markets. Whilst the investment did draw down across March, across the quarter generated a really solid result. And I think, again, as I referenced earlier, really reflecting some of the defensive qualities of these assets, as well as an ongoing, I guess, structural tailwind behind potentially around electrification and many utility companies involved in that process, which for a number of years has had a very supportive tailwind. So key holdings within an infrastructure fund such as this would include, utility companies, electrical infrastructure assets, telecommunications, very boring, I guess, traditional businesses, but they are very defensive and generate sort of regular cash flows for investors, and over particularly in periods of stress, can attract capital flows. On the flip side of that, we did have our worst performing position. There's always got to be one in the portfolio, but the Indian equity market drew down substantially over the quarter. Our position in the Indian Avenue equity fund drew down a touch over 21% as Indian equity sold off sharply. The Indian economy itself is highly sensitive to oil prices. It's a major input to, I guess, their GDP, making it one of the more sensitive economies globally, and the conflict in the Middle East really has created sort of significant disruption there. This position, I guess the severity of the drawdown has been, I guess, mitigated at the portfolio level to a degree via position sizing. This is one of the smaller positions within the portfolio, and we still remain supportive around the long-term structural tailwinds around India and their emerging economy.
Well, and I think the last comment you make is a really important one for us as an investment committee, but also clients and on behalf of their portfolios. Be careful not to be reacting to short-term noise. There is a lot to like about the Indian economy, as you've alluded to there as well. So, Ron, let's turn our attention to what the investment committee has been doing over the recent past. We've made some targeted changes, particularly around global value. So increasing exposure there and around small and mid-cap equity. So can you walk us through what you are seeing and what gave the investment committee the conviction to act at this point in the cycle?
Sure, Peter. So there was two sort of more substantial changes at the portfolio level that took place throughout the quarter. This value exposure, which I'll talk through in a minute, sort of took place approximately midway through the quarter. And we were looking to introduce some global value exposure to our global equity allocation. What that means is, I guess, businesses that are exposed to the value factor. Traditionally, these are companies that, are generally trading on lower, PE multiples or price to earning multiples for companies, but also generally tend to be more traditional businesses, more old world, and less exposure to what you would find in your, I guess, traditional benchmark exposure, which is highly exposed to, I guess, US large cap tech. So this allocation was funded from our UK equity allocation. For those that have been following the portfolio for a little while of time, you'll know that the UK equity allocation, or our tactical position in UK equities, is one that we've held for around 18, 24 months. It's performed really strongly and delivered great outcomes to the portfolio. We did close that out during the quarter and reallocated some capital to this value investment idea, which is really looking to capture a broadening of the global equity rally. What you'd find over the past 3 to 5 years is that tech stocks and AI names has really driven the market substantially higher, and equity market returns has been very concentrated to those names. There's been a lot of emphasis around companies behind the AI rollout, and I guess the companies directly involved in that. However, over the course of probably the last 6 months, that enthusiasm or momentum behind those names has really died out. And what you'll find over the course of this year, or particularly to the end of March, is a number of those Magnificent Seven names have sort of underperformed the broader S&P 500. I included a chart in our more detailed quarterly written write-up that sort of breaks down the performance of each of those names. At the same time of that, we also recognize that there's quite a substantial opportunity in old world businesses to adopt AI to improve margins and, I guess, ultimately their share prices over a sort of medium time horizon. And we believe a value strategy is one that's well poised to position on that. So a good example of a business that potentially fits this demographic for I guess locally would be something like Telstra. It's a business that's existed for a substantial period of time, very stable business, got the infrastructure in place, has a strong customer base. It's not really growing too much, but one way to substantially improve the business's bottom line will be to address the human capital side of the company's, I guess, cash flows. One of their biggest expenditures would be staffing, and if they're able to optimize AI and I guess lean into improving their workflows and efficiencies, they'll then be able to manage that cost base into the future and I guess drive earnings higher without necessarily needing to improve the top line substantially. So we think there's sort of I guess a number of companies that sort of fit that bucket, and we believe a value strategy is a value strategy is one that's really well positioned to capture that upside. Also in the portfolio, probably towards the back end of the quarter, particularly in the final weeks, we did top up on some higher risk positions within the portfolio. Specifically, that was Australian mid and small cap companies. We executed that via the Firetrail Australian Small Companies Fund, as well as the Fidelity Future Leaders Fund, and this was really to hedge a bit of upside risk within the portfolio. As many of you on the call would be aware, our portfolios have been positioned relatively defensively, particularly on that growth defensive split. And we had, I guess, a bit of dry powder or some defensive reserves that we could deploy into the equity market. The investment committee, sort of identified that there is a relatively strong upside risk to markets at that point in time, being any potential resolution in war or conflict could result in quite a substantial rally to equities, and that rally in equities could be very V-shaped. V-shaped equities, I guess, for clients and investors are very good. You get back to where you were very quickly, and it can drive really strong returns. But for us as, I guess, portfolio managers and managing a multi-asset portfolio, there is some implementation lag between when we decide to allocate to something and then reflect that in our portfolio. To sell and redeem an investment and then have that capital redeployed might take somewhere around a week. So we were sort of conscious of that and wanted to get some capital to work, given the sell-off that we'd seen across equity markets. So you can see just on the right-hand side here, we bought equities sort of towards the final days of March, on the 27th and the 30th. And those positions have obviously since rallied, coming out of that, as we've seen sort of a de-escalation of conflict within the Middle East. We did want to allocate specifically to higher risk strategies to execute this, so we could, I guess, get the maximum or the most upside from this position with, I guess, deploying the smallest amount of our defensive reserves.
Ryan, good lot of words in there, and you've used the word defensive 3 times now in the conversation, and I want to pick that up a little bit later in this chat as well. Just staying back, go back one chart, if you wouldn't mind, just to that last chart. That it looks difficult where you say, oh my goodness, with that red circle, it's gone down a lot. That's only in a period of 1 quarter, but the issue here, what you've exposed, is the opportunity to increase exposure during these periods of weakness. Can I get you just to quickly unpack what you think around timing versus discipline when markets are volatile like that? Just 1 or 2 key quick points on this aspect of saying timing and discipline versus reacting, and in many cases reacting negatively if people run away, whereas you've just outlined quite the opposite on that. Just a couple of quick moments on that one.
Yeah, so I think from a timing perspective, it's obviously very difficult for us to time markets. In this instance, we don't really know where things will land here, but in the short term, it appears we've got relatively lucky with our timing. But I think it really comes down to portfolio positioning. We had the portfolio positioned relatively defensively leading into this, so there are opportunities for us to increase risk, and I guess having the right mindset to be able to do that is definitely something that potentially not everyone has, being able to sort of step forward at a time where things are sort of scary, and that's really where it can help to sort of outsource your investment decision making.
Thanks for that, Brian. One of the 3 things, folks, that I said at the beginning, in this environment that we find ourselves, that investors are looking for clarity. That's being clear about what's going on, understanding the right perspective, and then, and you've used the word, we've just used that word there, disciplined about that as well. So thank you for unpacking that for a little bit. So let's move on to investment performance, folks. You can see that highlighted on the chart. Portfolios, Ryan, have been broadly in line with peers this quarter, following a period previously of strong outperformance. Can you walk us through what drove performance through this quarter, and what do you think this might look like just, in the context of the last 12 months? What are you thinking about in the context of the previous 12 months?
So as you mentioned, Peter, the performance over the quarter was largely in line with peer group. But when you zoom out, I guess, a bit higher, the last 12 months, we remain sort of substantially ahead of the peer group. And if you go a little bit further back over sort of a 3-year period as well, you'll find numbers also continue to look very good. I think one thing just to stress with investors as well, whilst the 3-month number is obviously negative, the further out you go, the numbers continue to look better and better. Last 12 months for growth portfolios, you're pushing above that 7-8% mark, doubling your money every 10 years, and 3-year numbers as well continue to look really solid. I think from an attribution perspective, leading into market volatility, portfolios were positioned relatively defensively. But that said, some of our risk assets, experience sort of greater drawdowns than what you'd find across the broader market, reflecting a very high level of dispersion across equity markets. And I think even within specific indices, if we use the ASX, for example, the market over the quarter was down roughly 1.6%. However, the average stock in the benchmark was down 5.5%. So what you'd find in that context is, the top 10 or top 20 businesses of our market perform substantially better than your average stock. And our Australian equity allocation is sort of quite substantially underweight that some of those top names, including Australian banks, which sort of, hindered our drawdown to a degree. There's some stuff on the other side of the equation, such as our currency positioning, our hedging program that offset that and delivered sort of positive attribution to the portfolio. But all things considered, we're sort of very happy with how the portfolio performed and has performed over sort of the last 3-ish years. I think one thing definitely to stress is the active management of the portfolio. So with this drawdown, ultimately, we're taking active decisions and trying to get the portfolio to a better place as we emerge out of this drawdown. It has been quite a quick rebound. Performance across April has been very strong, and the portfolios have come close to getting back to where they were. Ultimately, we want the portfolios to be in a better position when markets reclaim and begin to push into all-time highs. And that can be done by actively managing the portfolio and dialing up the risk at the right times. One thing to also stress as well is defensive allocations have continued to delivered positive returns over the quarter, broadly in line with cash. However, have exceeded cash over the sort of past 12 months. And any clients that had sort of defensive allocations around in their portfolios supporting that growth pillar have done better than the numbers shown here on this slide. Having that defensive buffer in their portfolio was particularly useful. And this is also speaks to our approach as well, where you'll find our floating rate solutions performed quite well, where your traditional defensive assets, such as bonds, drew down over the quarter in light of rising interest rates or rising bond yields.
Well, and thanks for unpacking that for us as well. So we're going to move into what in many ways is the section that people lean into the most, and that's the issue around, what does the future look like, the economic and market outlook. Clearly, folks, there's a lot happening. Don't need to tell you about that. Geopolitical tensions, rising energy prices, inflation still above target. The Bulldogs, are they going to, they're going to be playing the finals because their players are injured? Oh, and actually, that's not relevant, Peter. And just consumer pressure, supply. Is inflation on the way, as we said, above the target? Ryan, volatility, it is part of normal investing. How should investors be thinking about this period, and what does it look like from your perspective and the investment committee's perspective?
Yeah, we can get stuck into that. So I think if we look at it from a global perspective and the global economy, the US definitely remains the powerhouse behind, I guess, global equity markets as well as the broader economy. And we don't think the US is particularly susceptible to higher oil prices. You'll see on the orange line here on the left, obviously the spike in oil has been very large. Everyone on this call would be feeling that. However, the US is actually well positioned to navigate this. They're a net exporter of oil, and it doesn't really impact their consumers too substantially. They have a really split economy where I guess the people at the lower income end of the market, or the bottom 20%, do feel it, and that really sort of does impact them. But then when you get towards the other end of their market, the price of oil and gasoline doesn't have a substantial impact on their day-to-day operations, and they will continue to spend and support the economy as well. One thing that's also of note is that US corporates continue to hold up exceptionally well despite the broader economic or macroeconomic volatility. This chart here on the right shows the sort of annual S&P 500 earnings revisions over the course of the year. So what this means is at the start of the year, analysts set their expectations, and on average, companies generally don't meet those expectations. They are revised downwards over the course of the year as information becomes clearer. What you'll find on this green line is that it's quite a unusual period where you'll find earnings have surprised to the upside, and companies continue to benefit from a number of structural tailwinds that's allowing them to sort of grow and push their earnings profiles higher. Here locally, it's a very different story. We've obviously had the inflation issue, which everyone on the call would be aware of. Both headline and core CPI is well above, or has drifted above, the RBA's target band, which has forced them to push through a couple of interest rate cuts that probably not many people, including ourselves, probably saw coming. That has in turn really impacted both family finances as well as consumer confidence. You'll see coming into 2026 as both a sharp drawdown in both, household balance sheets as well as consumer confidence, which will continue to disrupt and impact our local economy more so than what you would find with your global markets or over in the US. So despite it being not really our war, it's we're going to pay more of the consequences of the conflict at the individual level.
Well, and the next chart's an interesting one. Lots of dots, lots of lines, lots of graphs. Can you unpack that and just what does it mean? Where does this look? This is again in regard to listed share markets around the world. Just unpack us this one, if you wouldn't mind.
Yeah, so it's a very interesting chart. It's one that JP Morgan published, and what's shown here is, the annual return of the S&P 500, which is the major equity benchmark over in the US. And you'll find, most years the equity market delivers a positive return. 35 of the past 46 years returns positive. However, despite that, in most instances, there has been a drawdown. So this red dot under the line on each year shows, the maximum amount that benchmark drew down, intra-period. And what this really highlights is that equity market drawdowns are sort of a normal feature of investing. And we want to stress that with both, prospective clients and our clients that have been with us for a number of times would be aware that equity market volatility is something that does happen, and with it in the portfolio level, it's something that we're able to use and sort of leverage to execute opportunities. But over the longer term, despite drawdowns occurring every year, investors have received really strong outcomes, particularly from the S&P 500. If we move into, equity markets.
Ryan, can I just jump in? Yeah, no, can I just jump in, go back to that slide? We all lived through the beginning of COVID 2020 and, February 2020 when the news hit and whatever. And if you look on that chart, I think it's, the red dot is minus 34. And this is the point that we want to make here is being very careful not to react to short-term noise. But the grey bar at the end of the year was up positive, I think, is it 16 or 17% from plus. So in actual fact, there's massive volatility over 6 or 7 weeks down negative 34. But if you held right through to the end of the year, you're up plus 16. And again, it highlights this word that we spoke about before, discipline, a really important part of that as well. And that's really what you're doing in partnering with us and our investment committee to keep the discipline in place. And that's a classic example of that. The next one's a really interesting one where equity markets are positioned there. Ryan, why don't you jump us through that one as well?
Yeah, I think this is a confluence of two factors. So equity market valuations are sort of shown here on the left-hand side by region, and what you'll find is the the orange dot is where valuations were entering the year, and then the blue dot is where valuations sort of were at the end of March. So you'll find that most benchmarks have declined, but also their valuations have pushed down as well. We've seen US equity valuations decline about 10% per year. But that's really a mix of two things. Yes, the stock prices have sold off, and that does help. But at the same time, concurrently, forward-looking earnings expectations have risen. So the equity markets, whilst they haven't sold off too substantially, they have become a fair amount cheaper as a result of the outlook also improving. And that sort of shows that again over here on the right-hand side. Despite higher inflation expectations, weaker growth forecasts, as well as geopolitical issues, this is a pretty similar chart to the one on the prior slide, but earnings expectations continue to sort of trend upwards across many markets more globally.
We're going to move to one of the most important slides, and one that a lot of people talk about of interest here as well, which is our positioning and conviction. Ryan, you've talked about portfolios being defensively positioned, underweight risk, but still looking to capture opportunity. Can you just walk us through how we're balancing that today on the various asset classes?
Yeah. So this slide here highlights the asset allocation of our diversified high growth portfolio on Hub24. It's our portfolio with the largest level of investments, widely used across the client base. But what you'll find is this grey line is sort of our long-term targeted asset allocation, and then the green box is essentially where the portfolio is positioned today. So what you'll find is there'll be particular asset classes such as enhanced income on the defensive side of the portfolio where we're overweight, and Australian equities is an example of an asset class where we're underweight. So if you zoom out and look at this from sort of a high level perspective, the portfolio is and remains underweight risk assets, and we are continuing to prioritize total return strategies, particularly within the defensive side of our portfolio, but also across private equity as well as the alternatives bucket within our portfolio. And we don't believe we're sacrificing a tremendous amount of upside to hold those positions. The recent adjustments to the portfolio during the quarter, you'll find there'll be around a 2% increase to Australian equities, and that was largely funded from the enhanced income allocation of the portfolio. So we sold down some defensive investments to buy some growth orientated investments towards the back end of last quarter, and that's been reflected in that positioning here. We continue to hold Australian equities as sort of a key underweight. That has really been the risk ballast at our portfolio. We really just believe there's sort of lower upside scenarios for Australian equities, whereas in global markets, the growth opportunities are probably more appealing. And then also, obviously, within the global allocation of our portfolio, where we're not necessarily constrained to a single region, so can access different parts of the equity market. The UK being an example of an allocation that's worked well for us recently. So continue to be neutral on sort of global equities. A lot of the risk is really being taken out of Australian equities. Alternatives continues to be sort of a strategic overweight at the portfolio level. Two positions in there, one of them around resources and one being focused on generating sort of more uncorrelated returns. But I think the main story is really around the enhanced income allocation and our focus on floating rate credit in that part of the portfolio. What we're sort of really talking about there is, I guess, corporate debt and structured credit, where I guess the base rate or the Australian cash rate is doing a lot of the heavy lifting. We've seen the cash rate increase over the course of this year, but then applying sort of a credit margin above and beyond that to sort of push the return up a little bit higher, and really looking to sort of eke out sort of returns, around that 7-8% mark from relatively defensive investments. Whilst they are defensive at that sort of 7-8% return level, investors are still able to benefit from pretty attractive absolute returns. And at that level as well, over a 10-year period, you're going to be doubling your money, but also offers quite defensive characteristics. So you'll find an allocation that we use in this part of the portfolio, the mutual high yield fund, for example, generated a positive return of 1.3% over the quarter. So really adding that diversification at the portfolio level. The other part of the portfolio where we're sort of slightly overweight is private equity, and that's really on the basis of some bottom-up opportunities that we're able to execute on in that part of the portfolio.
Now, Ryan, you've mentioned the word defence and defensive quite a lot. I was sitting here thinking, my goodness, you're starting to sound like the St Kilda Football Club coach. Defence, defence, defence. But I think the point you're making that defensive assets being underweight risk doesn't mean just sitting in cash. And so, you've outlined there just some of that area of managing risk and also the defensive positioning. So that's it's adding to performance through this period of time. So let's turn to a couple of areas where the investment committee has its highest level of conviction. Let's just work our way through a couple of those.
Thanks, Peter. So I'll just sort of highlight, I guess, what we're trying to do with this section of the webinar, and that's really introduce a couple of investment ideas that, one, we probably can't hold within core portfolios, so we are restricted to a degree with how much of the portfolio we're able to allocate to less liquid assets, but also a couple of investments that we believe are well positioned to, I guess, capitalize on the forward-looking market environment. So I guess the prevailing scenario for us, or where our sort of key concerns with markets are at the moment, is largely around equity market valuations, particularly within our local market. So you'll find these opportunities that we've highlighted here generally find themselves in the private market, so not necessarily exposed to the volatility of what you would expect with listed assets. So starting on the left-hand side, this is one that's been on the webinar for a couple of quarters now, but the Corval Property Fund, really looking to provide a degree of capital growth, but also some income for investors as well. The fund accesses a portfolio, actively managed portfolio of Australian commercial property assets. Corval has a very long-term and attractive performance record as a firm, consistently rating in sort of the top quartile of total returns, and they follow a very disciplined and contrarian investment process. I guess the asset class more broadly has had a very tough run. Unlisted real estate has probably been the only the only pocket in client portfolios for the past 3 or so years that hasn't really worked. It's been very challenged in late or more recently of a changing rate environment. You were in the coming into the decade, you had cash rates at close to zero, and now we're pushing up into 4s and 5s. There is leverage in this market, and that in turn resulted in a lot of assets needing to sort of reprice. It's our view that most of that is sort of behind us, and we believe it's a relatively attractive access point to the asset class, with an investment like this sort of targeting a total return of 8 to 10%, and the fund itself has very consistently met that sort of 5% income level into the future. On the right-hand side, we have the GAM LSA Private Shares Fund. This is a growth-orientated investment focused on accessing the venture capital market. The fund itself provides access to a portfolio of late-stage venture-backed businesses, predominantly headquartered in the US, and they will generally invest when there's sort of a clear pathway for that company to pursue an exit in sort of a relatively short time period, call that sort of 1 to 5 years. Why this part of the market we think is becoming increasingly attractive is it's really beginning to heat up. There is a long backlog of venture-backed businesses, particularly in the US, that are definitely IPO and public market ready. And we've seen sort of a key catalyst in that over the most recent quarter with SpaceX filing to go public later this year. There are a couple of other companies that definitely would fit the profile, and we're currently working through writing a more detailed paper for clients on this pocket of the market, the venture capital market, which we expect to include in this month's newsletter. What you would likely find, or what we would expect to occur, is if one company goes and has a successful listing, that will inspire many others. And a portfolio such as this has a number of names within, including SpaceX, that are sort of ready for IPO and then would push through their exit process over the coming years, and then that capital can then be recycled into new and emerging venture-backed businesses, and building for that next cohort and that next exit cycle. While we think the fund at the moment is relatively attractive, obviously we've spoken to some of the fundamentals, but at the fund level, it has generated sort of negative returns year to date, improving that entry valuation. At the same time, the Australian dollar has appreciated, toward our sort of purchasing power of parity, making it probably more attractive to buy US denominated assets. A venture-backed portfolio such as this is, predominantly exposed in US dollars, or entirely exposed in US dollars. And yeah, the appreciation of the Australian dollar does make it more attractive to consider buying USD denominated assets.
Ryan, thanks for that summary. On the slide there, you've seen the ability to get a combination of income and growth, and then equally for longevity portfolios, 5 to 10 years, and for generational wealth, the idea around private equity in quality unlisted businesses makes a lot of sense for those longevity portfolios. Ryan, thanks for your presentation. Really been excellent. A really clear overview, and I trust that people have really benefited from that. Can I just maybe summarise for you today just a couple of key takeaways and the key messages out of today? I think what Ryan's indicating here, that markets certainly remain volatile. We're seeing that, reading about it, seeing it on the news, in the media. But volatility is normal, folks. It's not exceptional. And for those of you who have lived a few number of years, we've been through these periods and greater, and we bounce back out of that. So volatility is normal. It's not exceptional. Nothing here that we're seeing that's really causes dramatic concern. Our portfolios, your portfolios, have been positioned deliberately and defensively, not reactively. And that's an important point. And I think Ryan was also highlighting to us that we're seeing better opportunities sets starting to emerge, particularly beyond where this narrow leadership of some of the big companies, the Mag 7, for example, of recent years. And importantly, and this is part of it all, very much discipline and diversification certainly remain key to long-term outcomes. Folks, if today's session has raised some questions for you, or if you'd like to understand how this positioning that Ryan's outlined today applies to your own portfolio, we certainly encourage you to reach out and speak with your own advisor. And equally, for those that are on the call or watching later on who may not be connected with Arrow, feel free to reach out to us directly, and we'd be delighted to have a chat, have a meeting, and just work through what that might look like. Or equally, you might be interested in a second opinion from Arrow Investment Management. Be delighted to do that as well. So again, thank you for joining us today. Really pleased to have you online, and for those that are listening later on, we appreciate your time, your encouragement, and your continued trust in Arrow. Thank you again, Ryan, for just that excellent presentation. Folks, we look forward to speaking with you again on another Arrow Portfolio Review podcast webinar. All the best, and bye for now.
Thank you. See you later.